This analysis report lays out a strategy for a high-risk, high-reward trade in Navitas Semiconductor, targeting what it calls a perfect entry.
And when you use a title like perfect entry, you're setting a very high bar. The entire analysis has to deliver on that promise.
Right.
So I think we need to jump right into that core assumption, because everything else rests on it.
Okay, so let's start there. I did like how the analysis laid out that $8.55 level. It calls it the floor, the technical line in the sand. The whole argument is built around that big intraday rebound, the hammer candle on the daily chart.
And the risk-reward is clear. You have to give it that.
It's crystal clear. Stop loss at $8.50, target at $13. That's a 4-to-1 ratio. It's compelling.
It is compelling, yeah. But I have to wonder, is relying just on a single day's candle, no matter how strong it looks, really enough to justify calling it a perfect entry?
Especially with all the emotional language.
Exactly. The whole narrative is about the puke point and scaring out weak hands. That's all sentiment.
And if you're basing it on emotion, you need the technicals to be absolutely rock solid, more than just one good day.
That's it. So I think the technical foundation for this perfect entry needs historical depth to really support the kind of risk it's asking for.
So the weakness is that it's just too focused on that one moment in time?
Yeah. It's leveraging that emotional story and that single hammer candle to justify everything. And that might undermine the authority of what it's calling a critical floor.
It makes the level feel a little arbitrary, almost lucky, rather than structural.
Right. So the suggestion is pretty straightforward. We need to integrate multi-time frame analysis. We have to show that this 855 level matters beyond just that one bounce.
We need to prove this wasn't just a random bounce, it was a collision with something real.
Precisely. So for a concrete example, the visual strategy has to change. Don't just point a red arrow at the bottom of that one candle.
What do you do instead?
You have to mandate showing a zoomed-out chart, a 6-month, maybe even a 1-year view.
Okay.
And on that chart, you establish that 855 is a historical congestion zone. Or maybe it was a major turning point months ago.
So the message changes from buy here to this is an established anchor point that has held before.
Exactly. It makes the floor structural, not momentary. And suddenly that tight stop loss at 850 feels a lot more authoritative.
That makes a lot of sense. It shores up the whole entry thesis. Okay, so let's talk about the structure of the piece, because the entry is one thing, but that $13 target needs fuel. So as I see it, the argument is twofold. There's a technical bounce happening now, and a fundamental catalyst coming later.
Right, the AI story.
Yeah, and the report structures this by talking about the ugly truth, the 50% drop, first. And then it saves that moonshot fundamental about AI chips for the very end in phase 4.
So it's trying for a big reveal at the end. I get that. But I see a potential problem there, a kind of structural lag.
Structural lag. What do you mean by that?
Well, the fundamental fuel for that high upside target, it's just introduced too late. That's the weakness.
Okay.
You're putting the core catalyst, that whole story about GAN chips for the AI revolution, at the very end. But you're introducing this insane 4-to-1 risk-reward setup much earlier, in phase 3.
Ah, I see the problem. So the viewer is being asked to accept the huge reward without actually knowing the reason for it yet.
Exactly. You're internalizing the pain of the stock being down 50%, but the justification for the massive payoff is missing when you need it most.
It makes the whole thing feel more speculative than it needs to, like you're just gambling on a bounce.
It does. So the suggestion here is to resequence the talking points. You have to weave that fundamental story into the ugly truth section right at the beginning.
So you reframe the downturn itself.
You reframe it completely. It's not just a problem, it's a strategic clean-out before the real growth begins. You turn the negative into the setup.
Okay, so give me a concrete example. How would that sound?
Well, in phase 2, when the report is talking about why the stock is down 50%, dumping their old cheap phone charger business?
Yeah.
Right after you mention that air pocket, you have to pivot immediately. You could say something like, they are making room for the real margin driver. Efficient power solutions for NVIDIA data center racks.
Okay, I like that.
Then you add, Wall Street hates uncertainty, but the smart money sees them securing the picks and shovels of the AI gold rush. You connect the pain to the opportunity, instantly.
And then that $13 target feels earned. It's not just a number on a chart.
It's grounded in a real high-margin story from the very beginning. That gives the whole trade thesis so much more weight.
I agree. That's a much stronger narrative. Okay, so for the third point, let's talk about some of the data that's already in the report but isn't really being
put to work.
Yeah, making the data work harder. I like that.
So the analysis lists key data points for the graphics. Things like 150 million in cash, no debt, and high squeeze potential.
Very strong data points.
Very strong. But they're just presented as these, like, ancillary facts. They're just background graphics, separate from the main argument about the entry.
And that's fascinating data that's just being wasted.
I mean, the report correctly frames this as high risk, high reward. But by isolating that strong balance sheet data, it misses this huge opportunity to actively mitigate the perceived risk of setting that tight 850 stop loss.
It's like you're telling someone there's a huge safety net below them, but you don't explain how that lets them be more aggressive.
That's a perfect analogy. So the analysis report needs to actively leverage the strong balance sheet as a primary risk mitigator, not just a passive data point.
So the weakness is just failing to connect the dots.
Exactly. It fails to use that $150 million cash position to stabilize the thesis. It makes the trade feel more exposed to, like, a fundamental business failure than it actually is.
Right, which might make a cautious person think, okay, the technicals look good, but what if the company itself is in trouble? And they might back away.
Yes, the tight stop is a purely technical bet on structure. The financial facts need to be used to prove that the risk being taken is only technical. It's about timing, not about the company's survival.
So the suggestion is to bring that financial data right into the risk-reward discussion in Phase 3.
Directly into it, to justify why you can be so aggressive at the bottom.
Okay, so what would that actually sound like? What's a concrete example?
So when you're detailing the 850 stop loss, you explicitly connect it to the balance sheet.
Okay.
You could say, look, while the technical floor is at 855, that 150 million in cash with zero debt provides institutional confidence that a major business failure is not on the table.
Ah, that's smart.
This lets us set an aggressive stop based purely on technical structure because we don't have to worry about fundamental solvency risk.
That's a brilliant reframing. It completely changes the character of the risk. You're not betting against the company going to zero.
You're just betting on price action and sentiment. That's it. It provides a huge amount of authority to the call.
Yeah.